When the Fed cuts rates, three things in your financial life move, and most Americans only notice one of them. Your mortgage gets cheaper, your savings account starts paying you less, and the stock market does something almost nobody predicts correctly. Fed rate cuts don't just live on the news. They show up in your monthly mortgage payment, in the APY on your savings account, and in your 401k balance, usually within 30 to 90 days. Stay with me, because by the end of this video, you'll know exactly what to do in each of those three areas the next time the Fed moves, and there's a specific number I'm going to show you at the 5-minute mark that, if you ignore it, could cost you around $90,000 over the life of one loan. Here's the part most financial news skips. The Federal Reserve doesn't directly set your mortgage rate. It doesn't set your savings APY. It doesn't move the stock market by pressing a button. What the Fed actually controls is one number, the federal funds rate. That's the interest rate banks charge each other to borrow money overnight. One single rate, set by a committee of 12 people meeting 8 times a year. But that one number is the foundation of a pyramid. Sitting on top of it, the prime rate that banks charge their best customers. On top of that, mortgage rates, auto loan rates, credit card rates, savings account rates. And sitting on top of all of that, corporate borrowing costs, which directly influence stock prices. So when the Fed moves the base of the pyramid by even 0.25%, everything above it shifts. The question is, by how much, in which direction, and how fast? And the speed matters. A Fed cut today doesn't change your mortgage payment tomorrow. It doesn't drop your savings APY tonight. There's a lag, different for each layer of the pyramid. That lag is where most of the money is either made or lost by ordinary Americans who don't know what to watch for. Now here's where it gets interesting. Because the first layer of that pyramid, the one closest to most American households, moves the most dramatically. And the math on this one decision could be the difference between paying off your home in 30 years and paying the bank an extra $90,000 you didn't have to. Let me show you exactly how. Mortgage rates are the second layer of the pyramid, and they're the one with the biggest dollar impact on the average American household. Here's how it works. The 30-year fixed mortgage rate doesn't track the Fed funds rate exactly. It actually tracks the 10-year Treasury yield. But the Treasury yield moves in anticipation of where the Fed is going. So when investors expect Fed cuts, the 10-year drops and mortgage rates drop with it. Now let's do the math on what that actually means for you. A $400,000 mortgage at a 3% rate gives you a monthly payment of roughly $1,686. The same $400,000 mortgage at a 7% rate, roughly $2,661 a month. That's a difference of $975 every single month. Over a 30-year loan, that 4 percentage point gap costs you about $351,000 in extra interest. $350,000 for the same house, just because rates were higher when you locked in. And here's the part the headlines miss. Even a 1 percentage point drop in your mortgage rate, from 7% to 6%, saves the average American homeowner around $90,000 over the life of the loan on a $400,000 mortgage. That's not a typo. 1%, $90,000. So what do you actually do? 2 moves. First, if you already have a mortgage at a high rate, set a refinance trigger. Pick a rate, usually about 0.75 to 1 percentage point below your current rate. And the moment 30-year rates hit that number, you refinance. You don't wait for the perfect bottom. Nobody catches the bottom. You catch the trigger. Second, if you're shopping for a home right now, get pre-approved with at least 3 lenders, not 1. Even a 1/10 of a percentage point difference on a $400,000 loan is roughly $9,000 over 30 years. Lender competition is real money. Okay, so Fed cuts are great news if you have a mortgage. But here's the flip side, nobody talks about. The same cut that saves the borrower money is actively taking money out of the saver's pocket. And if your money is sitting in the wrong account right now, you're about to lose roughly half of what you were earning. Let me show you where it goes. Your savings account, APY, is the layer of the pyramid that moves fastest after a Fed decision. We're talking 30 to 60 days, sometimes less, and the direction is always the same. Fed cuts, your savings rate drops. Here's the baseline most Americans are working from. The big national banks, Chase, Bank of America, Wells Fargo, pay an average savings APY of around 0.01%. On $10,000, that's $1 per year, not $100. $1. Meanwhile, the top high-yield savings accounts, Marcus, Ally, SoFi, Discover, several others, are currently paying somewhere between 4% and 5% APY. On the same $10,000, that's $400 to $500 a year. Same money, same FDIC insurance, up to $250,000. Same instant access, just a different account. Now here's what Fed cuts do to that picture. When the Fed cuts by a quarter point, high-yield savings APYs typically drop by about the same amount within 30 to 60 days. So a 4.5% account becomes a 4.25% account. A 5% account becomes a 4.75%, still way better than 0.01%. But you should expect the gap to compress over a multi-cut cycle. That's why timing matters. 2 moves for the savings side of this. Move 1. If you're still holding cash at a big bank earning 0.01%, move it. Today, open a high-yield savings account at any of the FDIC-insured online banks. The application takes about 15 minutes. The rate difference is roughly 400 times what you're currently earning. Move 2. If you have a chunk of cash you won't need for 6 to 18 months, say a down payment fund or an emergency fund layer, lock part of it into a CD before the next Fed cut. CDs let you lock today's rate for the full term. When the Fed cuts, new CDs pay less, but your existing CD keeps paying the rate you locked. This is the one savings strategy where being early beats being right. All right, mortgages and savings move in opposite directions. That part most people get. But the third one, stocks, is where almost every retail investor gets the timing exactly backwards. Because the stock market doesn't react to Fed cuts the way you think it does. It reacts way before them. Let me show you what that actually means for your 401k. Here's the part of Fed cuts that costs retail investors the most money. The stock market doesn't react to the cut itself. It reacts to the expectation of the cut, weeks or months in advance. By the time the Fed actually announces a rate cut at 2 p.m. Eastern on a Wednesday, the market has usually already priced it in. The big moves happened in the weeks leading up to the meeting, while traders were positioning based on economic data and Fed speeches. There's a phrase you'll hear in financial coverage: priced in. What it means is exactly this. The news is already reflected in the current stock price before it's officially announced. So if the market expects a quarter-point cut and the Fed delivers a quarter-point cut, stocks barely move. The expected outcome is already baked in. What actually moves the market is the gap between expectation and reality. If the market expected a quarter-point cut and the Fed cuts by half a point, stocks usually rip higher. If the market expected a cut and the Fed holds steady, stocks usually sell off hard. The trade isn't on the cut. The trade is on the surprise. Now, different sectors react differently. Growth stocks, your high-multiple tech names, your unprofitable software companies, historically benefit the most from rate cuts. Lower rates mean future earnings are worth more in today's dollars, and growth stocks are mostly future earnings. Bank stocks have a more complicated relationship. Lower rates squeeze the margin banks earn on lending, which hurts them. But lower rates also stimulate borrowing, which helps them. The net effect depends on the shape of the yield curve. Dividend-heavy stocks, utilities, consumer staples, REITs, usually catch a bid when rates fall because their dividend yields suddenly look more attractive compared to falling bond yields. So what's the actual move for a long-term investor? Probably nothing dramatic. If you're dollar cost averaging into a broad index fund like the S&P 500 or a total market fund, you should keep doing exactly that. Trying to time your buys around Fed meetings is a losing game even for professional traders. The data on this is overwhelming. Buying the rumor and selling the news works maybe 30% of the time for retail investors. The one adjustment worth considering: in a falling rate environment, longer duration bonds become more attractive than short-term treasuries because their prices rise as rates fall. If you have a bond allocation, that's the lever worth thinking about, not the stock side. Okay, you now know what happens at every layer of the pyramid when the Fed moves. But knowing isn't enough. Let me give you the exact 3-column action plan you can run the next time you see a Fed headline, whether they're cutting, holding, or hiking. And at the end, I'll show you the free tool the pros use to predict the next move before it happens. Here's the framework. Whenever you see a Fed headline, you ask 3 questions. Are they cutting, holding, or hiking? Then you check your 3 columns. If the Fed is cutting, mortgage, check your refinance trigger. If 30-year rates are now 0.75 to 1 percentage point below your current mortgage, start the refinance process this week. Savings. Expect your HYSA APY to drop within 30 to 60 days. Consider locking some cash into a CD now while rates are still elevated. Stocks. Keep dollar cost averaging. Don't try to time the cut. If you have a bond allocation, consider extending duration. If the Fed is holding, mortgage, nothing to do. Watch the 10-year Treasury yield as your leading indicator. Savings. Your APY is stable. Good time to compare rates across HYSAs and switch if you can pick up an extra quarter point. Stocks. Keep dollar cost averaging. Boring is correct. If the Fed is hiking. Mortgage. Lock your rate now if you're shopping. Refinancing makes no sense in a rising rate environment. Savings. Your APY is about to go up. Don't rush into a long-term CD. Ladder them shorter so you can roll into higher rates. Stocks. Expect compression in growth stocks. Keep dollar cost averaging anyway. Don't try to outsmart the cycle. And the free tool I promised you, it's called the CME FedWatch Tool. It's a public dashboard that shows in real time what percentage probability the futures market is assigning to the next Fed decision. That probability is usually a better forecast than what you'll read in any news article, because it's the aggregated bet of every professional trader with money on the line. 3 layers of the pyramid, 3 different moves, 1 Fed decision. The Fed isn't going to call you when they move rates, but now you know what to do when they do. If this video saved you the cost of figuring this out the hard way, hit subscribe. Every Tuesday, I break down one piece of how the American financial system actually works, in plain English, with the math you can actually use. Next week, we're covering dollar cost averaging, the boring strategy that historically beats about 95% of professional fund managers over 10 years. I'll link it as soon as it goes live. Drop a comment. Which of the 3, mortgage, savings, or stocks, are you most focused on right now? I read every reply. See you next Tuesday.